Hello everyone. For the whole month of April, several countries adjusted their interest rates. So, in this educational video, I thought it would be a good opportunity to explain what interest rates are and why they matter. In other words, I'm gonna give you some good information. So, first of all, welcome to this educational video. And as you can understand, as you've noticed, it's gonna be about interest rate and it's brought to you from TopFX. So let's dive in, let's get started. First, what are interest rates? For most people, interest rates are the cost of borrowing money or the reward for savings. Typically, they are expressed as a form of percentage, such as like 3% or 5%. However, interest rate encompass much more than just the fee paid for taking out a loan from a bank or gaining when you keep your money in a bank. In a savings account. Interest rates are a key tool that central banks use to steer the economy, to direct the economy. By adjusting interest rates, central banks can influence economic growth, inflation, employment, and even currency value. Let me break down everything of what I just said. So, number one, control inflation. When the inflation level of a country rises, the central bank raises the interest rate to reduce spending, to force people to stop spending as before. With higher rates, borrowing becomes more expensive. Consumers and businesses alike are less likely to take out a loan, which reduces spending and slows down economic activity. This action cools or slows down the economy and maintains or brings back a price stability. Number two, stimulate economic growth. When a country's economy slows down due to insufficient spending, like the opposite of what we just said, when people don't spend as much, and low demand, one follows the other one, central banks lower interest rate to stimulate that growth, to encourage people and businesses to spend. They do this by making borrowing cheaper. Low rates attract demand for loans from both businesses and consumers, which in turn induce spending. For businesses, easier access to a loan means they can invest in new projects, hire employees, and expand. For consumers, low rates encourage them to take out loans for homes, cars, or other luxury items, boosting spending. So in other words, with increased credit availability, demand rises, leading to increased production, much bigger job availability, and of course, higher wages, better salary. So overall, this results in boosting the economy. Number three, higher interest rate attract investments. Okay, let me explain. Higher interest rate tends to attract foreign investment. For the most part, foreign capital. So investors are drawn to countries, are attracted to countries with higher rates because they receive better returns on bonds and saving accounts. This action tends to appreciate the country's currency value. How? Okay. When demand for the country's currency rises to take advantage of the higher interest rate, the currency value, of course, rises at the same time. So it's like they trade together in a sense. Also, on the other hand, a lower interest rate typically leads to depreciation of that nation's currency. This can be advantageous in currency exchange transactions as it allows for more favorable conversion when exchanging from a stronger to a weaker currency. Then, number four, it encourages saving. High interest rate causes people to save. They stop spending, that they prefer to keep their money in a bank. People and businesses earn more from interest rate when they keep their money, when they have their money in a savings account and deposits. In the long run, saving causes capital accumulation. In other words, you keep it there, it grows bigger, which can be used after that to diversify, either for a business expansion or for new ventures or for asset acquisitions for consumers. Most of the time, buying a house or a car. Then we arrive to number 5, impact on employment. Lower rates can lead to more jobs. With cheaper borrowing costs, businesses may expand, hire more employees, and invest in new projects. On the other hand, higher rates can slow down the economy, potentially leading to job cuts or slower job growth as businesses face higher costs and reduce consumer demand. So, to sum it up, interest rates are fundamental to economic policy because they help steer the balance between stimulating growth and keeping inflation in check in a desirable level. By influencing borrowing cost, investment decision, consumer behavior, and even the currency value, they serve interest rates. They serve as a vital tool for central banks aiming to maintain a stable and prosperous economy. Thank you for watching. Feel free to leave a comment and by all means ask any questions. Don't forget to smash the like and follow for more. My name is Neil from TopFX. See you soon.